All right, day three or day two stock lecture Tuesdays. Fun stuff today, guys. We've got long-term key statistics, PEs, betas, all the good stuff. Hope you guys like it. It's really cool. Okay. Cool. Let's pull up Yahoo Finance. So you guys know Yahoo Finance is, it's pretty good. It's free. It's out there. I use it a lot. You don't purchase things straight through Yahoo Finance. You'll go through your brokerage. But if you're just looking around and you're not trying to actively do anything with it, Yahoo Finance is pretty good for just getting a general sense about stocks. Whatever stock you're looking at, you can get a pretty good, quick little look at it based off Yahoo Finance. So, if we can get this up, we're going to break down key statistics for basically any stock. And it's not just on finance. You go to most websites, they're going to have the core components of a stock. And a lot of it can be used to look at the long-term profitability of a stock, the long-term growth, stuff for long-term. For short-term, these statistics are more like a little bit of a grain of salt. For maybe swing trading, which is, you buy it one day, sell it in a couple days, or day trading, obviously buy it and sell it the same day. The key statistics aren't big of a deal, but for long-term, they're going to be like the backbone of entry points, exit points, the valuation of a stock, where it's going to go in the future. It's all going to be based off the key statistics, at least for some part. It's a much better way to look more in depth at a company for long-term investing, look closer at how good it's going to be in the next 10 years instead of maybe the next, week or something like that. So let's pull up a stock. I guess we go to Newell. We talked about them the other day, but just as an example. So, cool. So we have the price, got the ticker, NWL, and the market's still open since it's, before close. So we're going to talk about these numbers. These are big numbers. So first thing we're going to see is the previous close, which is 23.63. This is what this change here is based off of. So it was 23.63. It went down 76 cents, 75 cents, 26.88, and then it's also going to calculate what percent change that is. So that's 2.75%. That's down from the previous close. It's not based off of the open, which is 27.46. So if a stock closes at 10 and opens at 11, it's going to be up 10%. It's going to be up for the day because it's up pre-market. And as I talked about earlier, pre-market's less volume, it's after 4 and before 9:30 bell. So there's going to be some movement with catalysts. Most of the time, though, if there's no big news, there's not going to be huge moves pre-market. It's more like earnings reports, which we'll talk about in just a sec, when you're going to see those big moves or, big news. So, previous close and open. Something to know for short-term trading, this might be pretty much, there's about two things here that apply to short-term trading.
Just a meeting today? It's nobody here.
No, a lot of people, they had stuff, so they just wanted up.
I gotta leave early, but...
Oh, that's cool.
I thought I'd come in for like 10, 15 minutes maybe.
I'm going to upload it later, because I know a lot of people couldn't be here. So
Yeah.
It's cool. We're talking about the key statistics.
You just have a YouTube that you put on?
Yeah.
Okay.
Yeah. I can give it to you after class.
Alright, let's do that.
Yeah. So when a cheaper stock opens, or really any stock, if it closes and then it opens really far off of where it closes, like a 10%, 20%, a big difference like that, that's going to draw a lot of attention to the stock early in the morning on the next day. So that's really good for day trading because it's going to make it a lot more volatile. So if you have like a $10 stock and it opens at $12, people are going to be all around it. There's going to be a big increase in volume for the day because everyone's going to be focused on it. It's going to bring a lot of attention to the stock. And this is good for short-term moving. You can really ride the wave. People come in and just buy it because, wow, it's doing really well. Maybe great news came out. You don't really need to know that. If it opens up super high off of the previous close, then a lot of the times it'll pop up, especially in the early market, 9:30 to noon is when most of your day trading, most of your active trading is going to be. And a lot of that's going to be trading the stocks that go up a lot pre-market. and you don't know what they are, you don't know what the companies are, but you just see that, and that can be a really good indicator of a lot of potential momentum for the beginning of that day, maybe continued on. If you have a long-term position or maybe more of a swing trade and you see it open really, really high off the last day's previous close, it might be a good indicator that it might go up a little bit and then it's going to sell off and drop. So it might be good to maybe sell part of a position. If it goes up a lot, it's going to usually go down, and if it goes down a lot, say it closes at 10 and opens at 8, it's a little bit different volume-wise because you're going to have a lot more volume for stocks that are gapping up.
Tyler Gas to the office, please. Tyler Gas to the office.
But for stocks that are gapping down, it's going to be pretty bad. So a lot of the time early in the morning, it'll just be a big sell-off. And then it'll kind of, sort of like this, just kind of stay flat. A lot of the time it'll do that because people see it go down, they're staying away from it. They don't want to be near that. And this can be a good time to buy for some people, but the masses are going to say, no, we can't get near this. And it'll usually kind of even out. So big gains are going to attract people. People are going to want to buy it. And big drops are going to kind of push people away, decrease volume. There'll be more selling, but there's not going to be as much buying. Most of the buying is going to be in your gappers from your previous close to your open for the next day. So the next thing is the bid and the ask. This is also, the difference between them is the spread. So New Oil Brands has high volume, so the bid and ask is $26.73 right now and $26.72. So the spread is only 1 penny. The higher volume you have for the stock, the lower the spread's going to be. Sometimes spreads can be, half $1 on some of these really, really low volume stocks. So it's really important to look at that when you're putting in orders, especially with active trading. You're going to want to get in on the bid, so you're going to buy the bid and you're going to sell the ask. So to visualize it, the bid and the ask are basically sellers and buyers trying to meet in the middle. So we'll have the bid and the ask, and we might have 1050, 1060, 1070, and we might have the ask is 11, 10.9, 10.8. Obviously, it's going to be a little bit closer in the real world, but the price, the actual price, that 26.83 is the last price. So the last price, the last sale price, is what's going to be displayed for the stock, and that's what the last sale was, obviously. So it's going to be in between these. So maybe we'll have a seller at 1074 and a buyer at 1070, and the last sale was at 1074. That means the price of the stock is going to be 1074 on these tickers and what people see on it. So what that means for you, if you buy at market, you're buying the ask. If you sell at market, you're selling to the bid. The bidders are the people, this is what they'll pay for. The askers, this is what they'll sell it for. If you put in a limit order, which is where you want to be, you'll say, I'll buy it at this price. You can look at the level 2. This is called level 2, the bid and the ask. And you can say, let's buy in at 1071. And you can put a limit order at 1071. And what will happen is somebody can directly sell to you, or they can sell to the market. And if you're at the top of the bid, then you'll be the first one to be sold to. Basically, yeah. So you can see with the volume of the number of shares being sold, usually the further away from the last price, you'll see more people trying to sell or more people trying to buy, more people selling. So you'll have more people trying to buy at the lower prices and more people trying to sell at the higher prices. And the volume goes down into where they meet, and where they meet, obviously there's no volume there because the transaction occurred. There's nobody waiting to sell. So a limit order, if you sell, would just be saying, I want to sell it $10.90, and you'd put it in, and it would add to the volume for that little bar for where you're selling on the ask. Yeah, that's level 2, and that's what the bid-ask spread is. So lower spreads are better. They mean it's more liquid, and it means that there's going to be less manipulation, because sometimes there might be people and there's really big spreads, like maybe $1 on a $20 stock, something like that, and people will hype up a stock sometimes, something to be weary about, and they'll say buy this stock, but sometimes they might just be buying the bid and selling you the ask, and it could be a big difference for them in between that. So bid and the ask, buy the bid, sell the ask. Usually rule of thumb, if you're in a fast-paced trading environment, market orders are a-okay, but for long-term trading, most swing trading, and honestly, even most day trading, sticking with limit orders is going to be the way to go because you know exactly what you're going to get filled at. You're not going to get some insane surprise where you get into a trade and you're just automatically filled on the ask and you lose, a couple percent or something. That's not good. Day's range is the stock's price range for the day. Sometimes there's no slider here, but it'll be like the bottom of the range and top of the range. Midway through the day, this can be a good indicator of, is it at the bottom for the day? Is it at the top for the day? So if you're looking at buying for swing trading or long term, you're trying to time your entry, maybe try to get in on a day when it's at the bottom of the day range instead of being a really high gapper. Same is the 52-week range is just the yearly price range. So it'll tell you all of the range of prices for the whole year. So the lowest it was and the highest it was. You're going to see some of the tech stocks, the stocks that are getting a lot of attention, a lot of volume, a lot of media coverage will be towards the higher part of their 52-week range. And, they're setting new highs as well as they can. So if New Oil Brands was, if they released, some awesome stuff and they were really hyped up, they would be more towards the top of their 52-week range. And then sometimes there'll be companies in the middle and, they're going up, they're going down, they're varying. On their 52-week range. 52-week range, it's just a yearly chart. You're looking at the highest it was and the lowest it was. Stocks in the middle, maybe they're going up and down, but maybe they're on an upward trend. You really need to look at the charts to see that. But it's good to see maybe if it's the top, it's doing really well. If it's at the bottom, maybe something bad that year. Maybe the company is having a problem. If it's in the middle, maybe they're just going sideways and they're trying their best. It's good to look at just off the top of your head. Are they really low right now? Are they really high right now?
Ms. Painter's meeting is now starting in room 301. Ms. Painter's meeting is now starting in room 301.
Next thing is going to be volume and average volume. So average volume is usually the average volume for the past 3 months. So every single day for the past 3 months, the average has been $9 million worth of stock exchange for New Oil Brands. And today it's been $7.2 million worth of stock exchange for New Oil Brands. Average volume is good. The lowest volume you really want to see is in the 500, low 100,000 range. Especially for most of these big stocks, you're always going to want to see, at least $2 million average volume exchange. And that's just going to reduce your spread and it's going to make it a lot easier to get in and out at a good price. When you're day trading, you might see stocks with really low average volumes, but they have a lot of attention. They have some hype news. They open a lot higher than they closed, and that's when you're going to see the average volume for the stock might be like $40,000 or $400,000, but the volume in the first 10 minutes is like $2 million. And you'll see that a lot with a lot of the really hyped up stocks. They'll get a lot of volume really early into the market, and that's the people trading 9:30 to noon. That's their day trading. They're getting in quick, getting the fast-moving stocks and getting out. So you want to try to stay above $500,000 if you're just doing slow investing and there's not a lot of people, not a lot of hype around it. Volume is always good. Be very weary if a stock goes up a lot pre-market, but then its volume is really, really low pre-market, then it might just not be something to look at. Like if a stock goes up like 40% pre-market and there's only like 10,000 people or maybe 1,000 people bought it or $1,000 worth of it was exchanged, it's really not going to be as big of a deal as the stock going up 40% and then like $3 million worth of it was exchanged pre-market. So volume is going to show you how many people are on a stock and how liquid it is. Usually try to stick with high volume. Market cap is the valuation of the company based off of the price. So it's the price of a share times the number of shares. It doesn't say how many shares there are, but the company is valued at $13 billion. New Oil Brands is a $13 billion company because the price of its share times the number of shares is $13 billion. It just kind of shows how big a company is. You see trillion-dollar companies like Apple, or pretty sure Apple's a trillion-dollar company, Amazon, stuff like that. And they just have a really high price, or a really high market cap because the price is high and the shares are high. So that's just showing, it doesn't really mean a lot. Small cap, mid cap, large cap companies, that's what they call them. So a small market cap or a middle one or a really big one. It just shows kind of how big it is. It doesn't really affect trading that much. A lot of trading is based more on public perception and not really how valuable. The share price is not determined based off the valuation of the company. The valuation of the company is just the share times the price. It's just fun to say, how many billions of dollars a company's worth. Beta. Beta is a big one. So beta values go from 0 to 2. Yeah, probably 2. So values between 0 and 3. Yeah, 0 and 3. So values between 0 and 1 are going to be your least risky stocks.
Camden Oaks, please report to carpool. Camden Oaks, please report to carpool.
And Yahoo Finance calculates this beta value by doing variance, some things with variance, and it's a mathematical equation divided by number of days, stuff like that. The technicals of it aren't a huge deal, it's just how volatile it is, basically. But the beta is basically 0 to 1 is really safe. Really safe. It's the stock market. It's a number to take with a grain of salt, but a low beta is good, and for long-term investing, it's really good to see a low beta. You don't have to have one, but 0 to 1 is good. 1 to 2 is kind of medium beta. It's a little more risky, a little more volatile. And 2 to 3 is going to be, like your penny stocks. Like they're very volatile, very risky. Higher beta is riskier. Lower beta is better. So if you're looking at long-term investing, you see a low beta, that's usually pretty good. It can't tell you everything about a company. You're going to want to look at the charts. But it can help. It's good to see a low beta. All right, earnings per share and PE ratio. These are two big ones for long-term picks, and sometimes for swing trades and medium term, but mostly long-term picks. So EPS is in the financials. It's in their reports. It's part of their their quarterly report. They're going to have their earnings per share. So do the earnings divided by number of shares. And this company, Newell, made $5.63 last quarterly report per share. This doesn't really matter, but it's what they use to calculate the profit earnings, the PE ratio. So the PE ratio is the price of the stock divided by the earnings per share, so price to earnings ratio. So the $27 a share divided by $5.63 earnings per share gives you a PE ratio of 4.77. Now, this is really low, guys, but most of the PE ratios are going to be 15 to 20 for most of your companies. Lower than that means they're probably undervalued, something's going wrong. Higher than that means they're probably not overvalued, but there's a lot of hype behind them. There's something that's pushing it over 20. But what this really means is if you were going to go and buy Newell Brands right now, the stock price, you would pay pay $4.77 for every dollar the company makes. So if you pay $27 a share, you're buying $5.63 of their profit from the last quarterly report. So you're paying $4.77 for every dollar. And if you bought the entire company out right now and changed, absolutely nothing, and they made the same amount of money they made last quarter for the next 5 years, you'd make your money back in 4.77 years. So most of these are around 15 to 20. You're going to usually pay around $20 for every dollar the company makes in their stock price. Newell Brands, they're lower, so they're making a lot. They're making $4.77 per dollar their investors pay that for every dollar they make, which is low. It's good. Lower PEs are really good. Higher PEs, like I know Netflix has been flying up in like the 250s, the 300. I think they're down actually to maybe 200, 220. What that means is for every dollar you buy Netflix stock at, the PE is 220, say, and so you're gonna pay $220 for every dollar they make. So a lot of times PEs go up a lot, like Netflix, Amazon at the time, right now. They have really high PEs because people think, okay, their earnings is gonna go up a lot, their EPS is gonna go up a lot, and their PE is gonna go down because they're gonna have a lot more earnings. Or the price is going to go down, so it's just price divided by earnings. So if the price goes down, the PE goes up, obviously, which is what happened with Newell. Their earnings stayed the same, but the price went down a lot. If you're looking at long-term trading, that's when you use PE ratio the most. It's a really good indicator. You want to see if it's low, which usually means probably a good time to get in. If it's really high, maybe it's a little bit of a riskier time. Just look at the company. It depends on the company. Great indicator, though. Alright, next we're gonna talk about is earnings. So every quarter, public companies have to report earnings, and then every year they'll do an annual report. This Newell's earnings is on May 4th, 2018. So on May 4th, that's quarter one. Yeah. The report, their quarter one 2018 earnings. So here's a little quick chart we can see on Yahoo Finance. And we see last year, quarter one, the earnings was about 35 cents a share. And then quarter two, quarter three, quarter four, the earnings are in yellow. Every earnings report, March 4th, we're gonna have analysts that come in and predict how much the company is gonna earn. So I'm sure there's a prediction out. It's pretty soon. So maybe the estimate, the estimate is 26 cents a share. So they think the estimate's 26 cents a share. If they beat the earnings, usually the stock's gonna go up. And like in quarter three, they were below the estimate, so their stock, I'm pretty sure it probably went down. So if they match the earnings, it's usually good. Earnings are pretty much always good except if a company misses earnings. But even then, earnings can be good if revenue is good. Earnings reports aren't just about earnings per share, they're also about revenue and leadership. A lot of the times you can have really good earnings reports, they make a lot of money, but maybe they have really bad leadership, really bad revenue. Usually it's leadership, and the stock can still go down. But every quarter, companies can report earnings, and it's gonna be a pretty big catalyst for change. You're gonna see usually some of the most rapid movements off of earnings, kind of like news. It's big news, earnings report. So, thing to watch out for, usually you're gonna have volatile pre and post market. Forward dividend and yield. So basically dividend. Dividend is gonna be huge for equity investing. It's great. So this stock pays a 3.41% dividend. The dividend usually changes every quarter, or at least they can change every quarter. Some companies keep it the same. If we look at this chart, it'll show us the history of the dividends for Newell Brands. Each of these D's at the bottom is a dividend. And companies can pay yearly, they can pay quarterly. Newell Brands, you can see it pays quarterly because they have 4 D's on the bottom on the yearly chart. Their dividend last quarter, or quarter 4 2018 was 23 cents. Quarter 3, 23 cents. Yeah, it looks like Newell, 23 cents. 23 cents. So Newell pays a 23-cent dividend for every share that you own each quarter. And what this means for you is if you just buy Newell stock by the ex-dividend date is just the day you have to own the stock by to be qualified for the next dividend. So since they have a quarterly distribution, every quarter you'll get 3.41 divided by 4, and you'll get 3.41% at the end of the year from your dividends. So you can either have it pay straight in cash, and the company will pay you 3.41% of your position, or whatever the dividend percentage is for the company. They'll pay you that in cash, and you just get cash. It's just free cash. Or, and it's based off not the percentage, but the dividend that they pay. So if they pay 23 cents a share, the forward dividend on this stock is 92 cents. But that's basically just money, and for every share you have, you'll get whatever that amount is, and they can pay it to you in cash. It goes straight in your account, or you can have it automatically reinvest. So you'll get an extra, whatever the value of the dividend is will be in the stock. So you'll get extra stock in whatever the value of the dividend is. It's really good. It means that you can just buy the stock, and if it goes up, it goes down. You don't have to sell any of it. You just get the dividend. They just pay it to you. So you don't have to sell anything. You just get the money out of the stock. And then boom, you got, money that you didn't even know you had. Now you got money. It's really good for compounding. It's really good if you want to diversify. Maybe take your dividends in cash, put them in something else. I mean, it's good for down markets. If you have a dividend, you're going to get paid even if the stock goes down. Dividends are more reliable. You're going to get paid, every year or every half year, every quarter. No matter what. You can sell this. If you sell the stock, obviously you're not going to get it. You'll take your gains or your loss on the stock. But if you just hold it For the long term, or even, if you just want to buy it for a couple months to get your dividend, a 3.41% dividend that's what some bonds are. Some bad bonds, but that's what some bonds are. It's a good yield on some of these stocks. There's a couple of big companies, that they have really good dividends. They're called blue chip stocks. So, we look up blue chip dividend yields, and you can make a whole portfolio out of them. Let's see, suredividend.com. I mean, people build whole portfolios just based around dividends. If you can get, a 3% dividend on top of capital gains, that's going to be good. It's going to be really good. I mean, let's see, Apple, yeah, they got good dividend. I mean, GM, there's a lot of stocks pay dividends, but you can get like these are just big companies, and they all pay dividends. They're all great. I mean, not all stocks pay dividends, like Amazon. They don't pay a dividend. So right here it'll just say NA, no dividend. And then obviously there's no dividend date. Let's see, what PayPal they pay dividend? No. Dividend. Nope. Nike pays a dividend. I have that. Yeah. So for every share you have, you're gonna get 80 cents in a year. So that's 1.19% dividend. They're just gonna give it to you in money, or you can have it automatically reinvested into the Nike stock. It's really good. Just make sure you own the stock by the X dividend date, and you'll be qualified for the next year's dividend. And then the last thing is the 1-year target estimate. This is what analysts see the stock go into in a year. This number changes a lot. It's based off of speculation and predictions of some of the top analysts, and then they'll just average all the predictions together. You want to see a high estimate. High estimates are always good. Low estimates, conservative estimates, you might think, oh, well, this isn't going to grow that much, maybe. Or at least that's what the analysts think. The analysts don't think it's going to grow that much. So high estimates are good. If we could make some of these stocks have really high analyst estimates. And, for long-term investing, it doesn't really matter for short-term or medium-term. But for long-term investment, you're going to want to see, a high 1-year estimate, big gains. At least that's what other people think it'll do. And that's good. It means there's going to be more people looking at it, more people trying to buy it. Really cool stuff. All right, well, kind of shredded through that time. Level 2 is important, especially for active trading. Maybe not as much for if you're going to buy a stock for 10 years. But, level 2 for active trading is going to be huge. You always want to have limit orders on the bid and try to sell on the ask. And the last thing with the 1-year estimate is that's really not like a number. Once you hit it, the world's going to end. Once you hit it, you're going to stop. Once you hit it, you're going to crash. It really is just a best guess by some of these analysts. Yeah, that's the key statistics for stocks. These are all Yahoo Finance, free website. I mean, it's got ads, but you can run an ad blocker, or you can just, whatever. Yahoo Finance is also really good because they'll have news, so they have related videos, so just news videos about maybe Nike. And then sometimes there's ads on here, but if you scroll down and maybe a stock moves really fast, you can get news. So sometimes, news about the stock. And same, I think UA reported earnings this morning. Unfortunately, they had so what happened is that people predicted, oh, they did well, that's good. Yeah, so this will load. No? Oops. I mean, since they just reported earnings, oh, they still have. Oh, they report today after market. Yeah, because they haven't reported yet. So you can see though, there's ads. Not ads. There's articles about it, like, you know, people worried about it, maybe they aren't. These articles are going to be good for looking at, you know, really quick short term. What are the news? Why is it moving quick? This is where you can find a lot of the news about it. Yeah. They beat earnings. Okay, yeah, sometimes this isn't fully updated. These little charts on the side of Yahoo Finance, you can also see recommendation trends. This isn't a really diversified one, but you know, a lot of them will have like buy, hold, blah, blah, blah. If you see a lot of holding, a lot of selling, it might be, oh, the stock's on a downtrend, the analysts don't like it. And then here you're going to see revenue and earnings. So revenue, and you can see the earnings kind of went down. So at least this is yearly. So 2015, the earnings and the revenue grew to 2016, 2017. Or the revenue grew, but the earnings are going down. So that might, you know, be a reason to look at the stock and say, oh, it's not doing too good. All right. Well, that was today. Sorry we didn't really have any time for questions, but not a lot of people, I know some people missed, so it's cool. I hope it helped. Really important for long-term investing to look at that stuff. And yeah, tomorrow. See you tomorrow.